Are you being held hostage by your mortgage? I know that sounds a little silly, but it's actually a term or a phrase that is being thrown around in the real estate community these days because so many people purchased homes or refinanced their homes back in 2020 and 2021 at the artificially low rates in the 3% range. And so a lot of people are saying, well, I'm never going to move, or they're never going to move because they have a 3.25% mortgage and it doesn't make sense to move up. Well, with this week's total cost analysis, I'm going to show you why it could make sense to move up in today's interest rate environment. Let's face it, things happen. That's life. People get married, people get divorced, people have additions to their families, people have job transfers. It's not that big a deal, and it is something to consider, especially if, in this example that I'm using, you're a young family that purchased a home back in 2021. So this is a real mortgage that I'm showing you in a total cost analysis. You're a young family that purchased a home back in 2021, townhouse in Percival for $490,000. Fantastic, 3.25%, 30-year fixed rate. The home has seen nice appreciation. I checked a couple of different data sources today, and for that address, we're looking at about a 550 value, and they've got 28 years, a little over 28 years left on the mortgage. Well, of course, life happens and we have a new family addition. So they're thinking about moving up. Well, what does it look like? Let's take a look if we're going from the 550 townhouse up to, say, an 800,000 purchase price, and they sell their current home, 10% down payment, new mortgage, current rates, good credit, 6 3/8. Here's the payment. Here's the cash to close. So yes, their mortgage payment's going to go up about $2,500 a month. Well, let's take a look at what it really means, and let's look at net worth. So if they stay in the townhouse and don't move, net worth over 15 years, property appreciation, assuming a 3% average, which is pretty low for this area, their equity would be about $584,000. Well, let's say they sold the house and got the new mortgage, their mortgage payment's up, but now they're in a bigger house, have room for the kids, family, etc. Their equity then jumps up to 726. So right there, we've got net worth just on house appreciation from the 3 1/4 townhouse to the new 6 3/8, which, oh, by the way, if they have the opportunity in the next 10 years to refinance, that equity will build even faster. Let's say that they kept the home, rented it out. And I did also look up rentals in that subdivision, and they're renting for about $3,000, $3,200 a month. The last 6 months, there have been 5 that have rented. So that $2,900 more current mortgage payment is going to be covered by rent, easy, cash flow, no problem. They buy the house, keep the townhouse as a rental. Now, all of a sudden, we've got appreciation really working for us. And we've got the 584 plus the 726. In 15 years, net worth $1.311 million. So this is just a great example showing you how real estate can help net worth, how it affects net worth. In the total cost analysis, when you click on the more info button, you'll see a breakdown of current home showing the total net worth via appreciation. And then the same thing if they sold the house and bought a new house. And then the same if they kept the current house, bought a new house, total appreciation. If you are thinking about moving up and are worried about interest rates, what's going on, don't worry. Give me a shout. I'd be happy to put a total cost analysis together for you, show you what different scenarios would look like. Hope you're having a great day, and I look forward to speaking with you soon.